We need to take our next step in the show though and go right to our wrap the week segment. So at the end of every week, what I like to do, and this is really based off of my weekend routine, I like to look at a series of charts, take a step back. Now that the markets are closed, we've got the weekly close locked in. Let's look at the big picture. Think about how this week fits into the longer term trend. Again, my goal with all of you over time is to always connect what we're seeing right now with the big picture, and no better time than now in this sort of environment to try to orient yourself effectively. So we're going to start with the Mindful Investor Live chart list. Again, if you've not seen this before, if you don't have it, on StockCharts, go to the articles page, go up here to StockCharts blogs, you can go to my blog called The Mindful Investor, and you'll see this link right here that says live chart list. That's going to get you right back to this point where we can look at some of these charts together here. So looking, you can say that right to your login, by the way. So looking at the first one, this is a market trend model. I tweeted this out earlier with some comments on what this means. And just to share with you, when you're thinking of the long-term trend, we have a lot of tools in our toolkit to understand the short-term movements, but I like to have something that's more of a long-term trend following mechanism, not triggering too often, just giving me the big picture. Are we in an uptrend or a downtrend? And it's based on long-term moving averages. Mine's based on the 21 and 34-week moving averages. I've also at times used the 13 and 34-week moving averages. They give pretty similar signals. The idea is it's not going to give signals very often. There have been years at a time when it doesn't trigger. It just kind of stays long and stronger in a certain configuration. But what it does do is it's meant to trigger before a climactic loss, a beginning of the move, which is what we saw this week and last couple weeks. It has not triggered yet. It's still long-term in the bullish category because it's not going to trigger until things really start to go lower. So it would be designed to prevent a much deeper loss going down. It's trying to keep you out of a secular bear market too long. So having said that, still positive, and it's really because of the severity of the sell-off that will make a trend-following device. We'll have to wait a little bit to catch up to that. So the weekly PPO here using it, you can see it's been bullish since the second month of this year, coming off of the lows last December, and has remained positive and remains so. But the shorter term sort of tactical read that I incorporate on this is a weekly PPO, similar to a weekly MACD using the traditional settings 12, 26, and 9. And as you can see, this turned negative in mid-February, sort of suggesting it was on that big down week saying short-term trend is down. So even though the longer-term trend is up, you want to sort of take some risk off. And that's where it's at right now. Still negative short-term, but long-term still saying we're in an overall positive trend. We'll have to see how the coming weeks play out. I would point out on the weekly chart, remember, as exciting as Friday's move was, that brought us back up to about the midpoint of this last week. By any definition, looking at the weekly charts, it's been a down week. And again, I would continue to think of it that way. Going into next week, we'll have to see how things play out. Going quickly through some of these other charts, this is the breadth measure we use a lot of times. And again, by any description, the advanced decline lines have been fairly negative. Breaking down through the most recent swing lows has been key, and that's after a bearish divergence with a lot of the advanced decline lines that we saw. This is not updated for today, so I'd expect that to jump up in a pretty big way. It's going to recalibrate these a bit. We'll have to see next week how we fit that into the big picture. But leading up to today, for sure, overall leaning negative. It takes a little while to sort of change that and go more positive. This is another one updated as of yesterday. This is our new highs and new lows. So it's basically when the New York Stock Exchange in the very bottom panel, the S&P 500, new 52-week highs, new 52-week lows. Again, this isn't updated yet for today's close, but you saw yesterday 300 out of the S&P. So 60% of the S&P saw a new 52-week low yesterday. That is really extreme. And you'll notice what I point out when I talk about these this sort of environment and why it seems so unusual. When you look left on the chart and you find absolutely zero historical reference because we've never been this low over that period, that's when you have to really look at the longer term stretch and try to make sense of it. So let's do that together really quickly. We're going to bump this out, go into the time frame. Let's go back about 15 years or so. That'll take us back into sort of the aught fives or so. That'll give us the 2007 sell-off. So what happens here is you can see with yesterday with that big sell-off, that puts us in a different territory than what we've seen in these most recent pullbacks, these bottoms within the secular bull trend. And it puts us more within that 2008, 2009 sort of range. That's the last time we really got anywhere near this sort of level where over half of the S&P was making a new 52-week low. And really the last time we were over 50% was back here, that leg just before the final leg down, that capitulation low. This was in 2008. So again, it's hard to draw too many comparisons just based on that. But I'm just pointing out the fact when the breadth has become this negative, it's putting us back in the breadth characteristics of previous major bear market phases, not just short-term pullback. So I would certainly want to remind everyone of that. Again, yesterday's sell-off also pushed the percent of stocks above their 200-day down almost to 5%. We're going to come back up. I think a lot of stocks have reclaimed that, or at least begun to, in some of the higher beta names for sure. But again, it's the lowest reading that we've had in the last 5 years. Again, going back into 2008 is where you'd see previous time. And we only had 1% of the S&P above their 50-day, which is incredibly rare. But again, back to some of those cyclical bottoms. So, in this sort of environment, again, thinking of the charts and just looking at how negative the breadth is, one of two things happens. Either this in some way starts to rhyme with historical cyclical bottoms. And again, we want to look at a lot of reference points to try and see how close we are to that. But the other thing it starts to look like is earlier on in deeper bear market phases. And that's really the concern. So this is a really good time to be thinking about positioning over the weekend, think about stops and all of that. We talked about this one yesterday. I just wanted to bring it up to point out that the AAII, the American Association of Individual Investors, this is their weekly survey, came out yesterday. So it's not going to reflect anything today, but over 50% bears, which again is super unusual, lines up with some of the cyclical bottoms that we saw previously, but much more lines up with the range that we tend to see in deeper bear market phases as well. Now, this ratio is actually one of the interesting ones, and we're going to rotate and look at some of the Scooter reports very, very briefly. Looking at the ratio of consumer discretionary versus consumer staples as the market spikes up. This is reflected through today's close. You would expect people to be pushing into offense, pushing into consumer discretionary, taking the high road and expecting the juice if there's further upside. I think it's really worth noting that people are actually sticking with staples. And by people, I mean big institutions, right? The institutions are rotating more and more to staples. That's been a trend that's been going on for a while. Today did not change that. So consumer discretionary is actually one of the weaker sectors today. It was not one of the gainers. So I would hesitate to think too much about that as potential upside here. Finally, I just want to very briefly remind everyone about the Scooter reports. We don't have enough time to really dig into these too deeply, but I did want to point out, again, today really changed the characteristics of this. If you look at the Scooter report, switch it to U.S. industries and go here to the left, say 1 week, you can see the strongest rated groups, and you can also look at change and see which groups were up and down the most. What's interesting here is you see some healthcare, you see some telecom, you see some transportation, some really interesting groups that have gone on the most improved list based on what's been happening through the week today. Again, as we update this through today's close, we'll probably see some new information on there, but overall, very much worth following.